I'm Aaron Cofera, and I'm joined by one of my partners here at the Bonadio Group, Lisa Palladino. And over the course of the next few minutes, we will be taking you through CECL and its overall impact on the practice as a whole, and also what we're seeing from a review perspective. So just at the beginning, we have a normal disclaimer here that this presentation is just our opinions and do not necessarily reflect the views of our other partners or other colleagues here at the Bonadio Group. But with that out of the way, I think we can just get right into it and just get started on kind of just giving some oversight and discussion on CECL. So with that in mind, Lisa, maybe you can provide us with just some background as to what CECL is, why it was issued, just kind of help us understand where it came from and that sort of thing.
Sure, Aaron. So due to the financial crisis in 2008, they kind of changed how people were recording reserves for receivables and losses on their balance sheet. So it's more of a current expected credit loss model meant to replace the incurred loss methodology as an expected loss model. Really meant to input some sort of reserve on the records on day one instead of down the road and then looking back, more of a prospective approach instead of retrospective. So you'd record a credit loss based on your current historical experience and the current conditions, the financial climate in the United States as it is right now, and kind of trying to figure out what's going to happen in the future. And that's where the challenge really lies is we don't have a magic 8 ball, and you really are trying to figure out what's going to happen down the line.
See, I'm envisioning you go into one of those psychics and they kind of read and tell you your forecast of what's going to happen in the future, but it doesn't sound like that's necessarily the case. It sounds like we may have to have some potential data that kind of supports those overall assumptions in the versus going to that
Exactly.
psychic. So,
Yeah.
Okay. But maybe the psychic can help us get there, right? I mean, you never know.
Right.
So, from an effective date perspective, when is it effective? I know for SEC clients the Wells Fargos of the world, the big financial institutions, they've already adopted. But what about everybody else?
So all the private and companies, it starts January 2023, opposed to other ASUs that have come out. Typically, you look at the year end, but this one starts as of 1/1/23, which means all of your interim financial statements that this is going to apply to, the year end financials and going forward.
It's an interesting point that you have there on the interim financial statements. I think that's been a sleeper in practice. I think a lot of people that might issue quarterly financial statements, definitely on the financial institutions or SEC side, you definitely see it in the quarterly filings. But also, if you're a private company and issue a comp without notes or a comp with notes for that matter, if it's a quarterly or monthly statement, you ultimately have to apply the CECL standard anything subsequent to 1/1/23.
Exactly, Aaron. So, interim financials, if your internal financials are based on generally um, accounting principles, then you should be applying this on your internal financial statements.
Mhm.
If you're using the GAAP method.
And I think I can speak a certain extent on what the impact's been. And I think the impact has really surprisingly been all over the board. For some of our clients, there has been a significant impact on an adjustment to their opening retained earnings for the recording of this. And other entities, it hasn't had any impact at all. And I think ultimately the difficulty that most of our clients are having is really just coming up with that initial forecast and coming up with the analysis. There's a lot of time that goes into coming up with the number of zero, even, if you will, because it
Yeah.
doesn't sound like there's any way to get around this or get out of it, is there?
No, just the mere fact that you never have write-offs, so you don't have bad debt, that doesn't really get you there. You still have to go through the methodology, come up with a calculation, and then determine, is that material to your financial statements, and then move on from there.
Mm-hmm. Okay. Interesting.
So Aaron, what on my balance sheet's going to be impacted? What accounts does this affect?
So it's a good question. And I think, there's a couple ways to look at this. I think most of our clients are not not they don't have a lot of financing assets. At a very high level, it's financing assets. And what does that mean? Like loans receivable. And that's why when this first came out, you heard a lot of people saying it's going to really hit the financial institution industry. And it has had a significant impact on those entities because they have a lot of loans receivables on the books. I think for the bulk of our client base, for our non-public entities, it's really going to impact the trade receivable accounts and any sort of guarantees that they may have for any other entities, any unfunded commitments, which again, I don't think generally for our client base, there will be a lot of unfunded commitments. And on the construction side of the house, there any kind of contract assets, such as like a cost in excess of billings, those would actually be fall under this standard and need to be analyzed as well. So it also impacts anybody that has any sort of investments like held to maturities, any sort of accrued interest receivable. If you have a loan or something like that, there may be something there that has to be analyzed. Now, loans with related parties are under common control, are scoped out. So a little bit of help there, but probably not as significant because most of our clients have receivables. They're not in a all cash business per se, if you will.
Right.
So just thinking about after you've gone through, I think that's part of the tough part is first and foremost, you have to figure out what is impacted on your balance sheet, right? And I think if you look at your balance sheet and it's a simple balance sheet, and let's say you only have trade receivables, what's really going to change as a result? Obviously, you did allude to the fact that you're going to now be recording some sort of reserve, but other than that, what's really going to be moving the needle or really impacting our clients?
So I think mostly what they're, for example, for trade receivables, I think you're gonna end up looking at potentially each of your buckets, 0 to 30, 30 to 60, 60 to 90, seeing in each bucket or like kind of receivables, what percentage of those may you not recover. You might not get that money. So I think you're gonna have to do a little bit more of some really kind of some soul searching on your trade receivables to see what's the impact and be very realistic of what you might not get paid on. Um, there's going to be qualitative and quantitative disclosures over this analysis. So if you have forecasts, it's supposed to provide users a better understanding of the overall assumptions and judgment and analysis that goes into determining the credit loss recorded. Um, you'll be able to each prepare the financials will be able to tailor to your specific scenario on how CECL is affecting you and what your methodology was to come up with some sort of a reserve.
And I think that's the nice thing about this standard. I guess if there is one nice thing of the standard, right? I mean, they're all nice if you ask me. But anyway, is that you're able to kind of tailor it a little bit to your specific situation. And where that's great. It also may provide some complexities because if you have more than one method for determining an allowance calculation, you may now have a lot more disclosure that to describe that, whereas in the past maybe you didn't. So it's definitely something to be cognizant of, that there might be some additional disclosure, and also probably for the stakeholders of the financial statements, they may not be expecting it. And now
Right.
there's this kind of not a surprise, but because we've been talking about it for a number of years now, but something that's maybe a little bit different than what they're used to seeing.
Yeah, I think correct me if I'm wrong, but I think on financial statements with footnotes, there's going to be another couple pages that are going to be added on those footnote disclosures, right?
Yeah, and the good thing is that there's a lot of talk around like a lot of vintage disclosures. Fortunately, those are for SEC clients,
Mm.
so we don't really necessarily have to worry about those unless we're an SEC client. So that's a good
Yeah,
thing because they're definitely very very lengthy and cumbersome for sure
okay.
So maybe we can just kind of talk a little bit about kind of where do we begin, and I think what I think the best way to look at this is, let's just go under the assumption that we're just talking trade receivables here, and kind of we did talk about looking at your balance sheet and saying, okay, I've only got trade receivables, and we're going to go under a very simplistic model here. Kind of how do you do that? And there's really 4 easy steps that you can kind of follow. You pool your trade receivables and say they're all here, and you kind of have to do that through looking at their individual risk characteristics. And when you think about risk characteristics, it can be something as simple as their credit score, or where our clients are, where your receivables are located. It can also be what type of customer they are. So I think, Lisa, we worked through an example a few months ago, and they were able to disaggregate it down to between retail, commercial, and
Right.
construction.
Hmm.
And I think once they did that, it was relatively easy to see where the risks lied from a collectability perspective.
Right. Right.
And then ultimately you go through, and if you're going to do the receivable, in this example we're going to go through, it's going to be a receivable method. You're going to use the aging metrics, and then just go ahead and calculate that based on your understanding and kind of your analysis that you've performed on the overall uh, population. So I guess the example that we have here is really right out of ASC. It's 326 illustration 5, which is where ASU 2016-03 came from. And really what it does is it kind of gives you an example of a aging matrix, which I think we believe will impact the majority of our clients. And really what it did is it looks at a manufacturer that sells to a broad range of customers, mainly retail. And ultimately they've gone through and did a historical analysis and said, this is kind of the percentage of receivables and where they are in the aging cycle that will become uncollectible. So obviously, more heavily weighted to the back end, that a higher percentage that are over 90 days are not going to be collected in something that we just sold through today. As part of that analysis, so that's step one, right? As part of this process, you go through and you say, okay, based on my historical factors, I'm going to come up with some sort of analysis and say, this is where I think we're going to fall out from a collectability standpoint. Then you're going to look at everything else that, at least as you mentioned, you're going to look at kind of where the economy is, what unemployment is, and if you're going to look at it potentially in your area of the world as well as to where your clients are. Obviously, if they're in a very bad part of the country where there's certain unrest or high unemployment, it's going to be a potentially different answer than if it's in an area of low unemployment. And the example in the standard uses an area where there's lower unemployment and the economy looks like it's improving, and ultimately everything is looking rosy, if you will. So at the time of this analysis, they're ultimately saying we can take a 10% haircut on each of our overall factors that we're using. As a result of that 10% haircut, they go through, they whack off 10%, they come up with a credit loss rate, they apply it to their individual basis, and then they have an amount to record. And in this case, it's the number here, and I don't have my glasses on, so I can't see because my eyesight's so bad. You've got about 18 points, 18,681 is what the overall calculation comes out to be. So I think just a couple things with regards to this is if you are doing it on January 1, and this is the analysis that you go through, that's your day one impact. If you do an analysis subsequent to on a quarterly basis, you would adjust your credit loss allowance to get to that 18,681. So ultimately, there will be an impact in your P&L. This is an analysis that does have to be done and revisited on a reporting period. So every reporting period that you report, you have to go through this analysis. So you can't just do it on 1/1 and then not worry about it and issue financial statements all year and then revisit it as of 12/31. The standard's not going to let you do it. You have to do it for each of these individual overall reporting periods every time you do it. So I think at a high level, that's kind of what the new CECL standard's looking like. That I think we covered everything. Lisa, is there anything that you think we're forgetting, or do you think we've got it?
No, I think we've got it, and our information is right here. So if anybody has any questions, they can always reach out to us or the Bonadio Group, and we can hopefully help them out.
Excellent. Thanks, Lisa.
All right, thanks, Aaron.